students, welcome back. This is Dr. Mercado speaking. We are continuing with a content over Chapter 9 dealing with long-term assets, fixed and intangible. Okay. Now in this presentation, I am going to be covering exercise 918, which deals with a disposal of a fixed asset. Okay. So by now, you should have already read the chapter and be familiar with the content. As you're working your assignment, if you have any questions, please feel free to contact me. Please make sure that you do organize your time to make sure that you do complete your weekly assignments on time. Okay? The only way we're going to learn accounting is by doing it. Okay? So we need to practice, practice, practice. Okay? So this practice deals with a disposal of a fixed asset. It tells us an equipment acquired on January the 6th at a cost of $375 has an estimated useful life of 20 years and an estimated residual value of $25,000. Requirement A. What was the annual amount of depreciation for years 1 to 3 using the straight line method of depreciation? Requirement B. What was the book value of the equipment on January 1st of year 4? Requirement C. Assuming that the equipment was sold on January 3rd of year 4 for $300,000, journalize the entry to record the sale. And then requirement D. Assuming that the equipment had been sold on January the 3rd of year 4 for $325,000, instead of the $300,000, journalize the entry to record the sale. So we have 4 requirements in this assignment. The first requirement is to figure out the depreciation for years 1 through 3 using the straight line method. Okay, and I obtained this Exhibit 4 for the straight line method from your ebook. Basically, to calculate your depreciable cost, you have to get the initial cost of the asset, subtract any residual value to get the depreciable cost. Once you get the depreciable cost, then you divide that over the useful life, okay? And it's going to be the same amount, the equivalent amount every single year, okay? So let's run the calculations for this particular problem, okay? So it says here that the equipment cost me $375,000, okay? It also says that we have a residual value of $25,000. That needs to be subtracted, okay? And then I'm going to divide over my useful life, and it says here that this is going to be useful for 20 years, okay? And let's see what we get. Okay, let me get my calculator out. So I've got $375,000 is the cost of the asset minus my residual value of $25,000. That gives me $350,000, and I'm going to divide that by 20 years. So that means that every year I am going to depreciate it $17,500. That is my annual depreciation, okay? So that's going to be the depreciation for year 1, for year 2, and for year 3, okay? This is the calculation. The cost minus the residual value over the estimated useful life, okay? So now I can calculate my total depreciation for those 3 years. So for years 1, 2, and 3, my asset has depreciated a total of $52,500, okay? So requirement A. What was the annual amount of depreciation for years 1 through 3 using the straight line method? The annual amount was $17,500 annually. The total for the 3 years is $52,500. Now, requirement B is asking us to figure out the book value of the equipment as of January 1st of year 4. Okay, so I know that my equipment, okay, cost was $325,000. Okay, now I need to figure out, be very careful here. It says, what was the book value of the equipment as of January the 1st of year 4? So in order for us to figure out, we have to figure out how much has been depreciated the first 3 years. Okay, well, we already figured that out, and we know that we depreciated it $52,500 years 1, 2, and 3. So at the beginning of year 4, this asset has been depreciated $52,500. Okay. So my book value is going to be the $325,000 minus the $52,500. Okay. and it's the equipment cost was $375. I mistyped it. Okay, I was like, what's going on? So my equipment cost was $375 right there. Okay, it was depreciated for $52,500. So that means my equipment book value is $322,500. So all I did was my cost. It cost me $375. I subtract my depreciation for the 3 years, $52,500. That gives me my book value of $322,500. Okay. Now, the difference between the fixed asset account and its related accumulated depreciation account is called the asset's book value or net book value of the asset. That is how much we are carrying this asset in our books for. Okay, it doesn't mean that this is how much it's valued at. It just means this is how much we have valued it at in our books. Okay, so I know that I've purchased it for $375 based on the straight line depreciation method that we are applying. It's been depreciated $52,500. So our book value is $322,500. Okay, that is requirement B. The book value, $322,500. Now, requirement C. This is where it gets a little bit tricky. It says, assuming that the equipment was sold at the beginning of year 4. This has happened on January the 3rd. So it's at the very beginning of year 4, and we sold it for $300,000. Journalize the entry to record the sale. Well, first we need to figure out, do we have a gain or do we have a loss? Okay. So I have a little calculation here. Okay. I'm going to start off with my book value. Okay. So the book value that we calculated as of the end of year number 3 was $322,500. Okay. We had already calculated it in requirement B. That was my book value. Okay. It says here that we are selling it for $300,000. Okay. So I have it in my books for $322,500. I sell it for less. I sell it for $300,000. Okay. So my sales price minus my book value, that's going to give me a loss of $22,500. I sold it for less than we had it in our books for. So I'm going to lose out on $22,500. Okay. So we have to be very careful. How much did we sell it for? For $300,000. What's my book value? You compare the sales price to the book value. Okay. And then in this case, my sales price is less than my book value, so that means I have a loss of $22,500. Okay? So now let's journalize that entry. This is happening on January the 3rd. The first question is, how much cash did we receive? Okay. According to the problem, we sold it for $300,000, so we received $300,000 in cash. Okay? The next thing we have to do is we have to clear out our accumulated depreciation account for the equipment. Okay. So how much did we have in the accumulated depreciation as of that point? Well, from the beginning of, since we acquired the asset to the end of year 3, we had depreciated at $52,500. Okay. We haven't depreciated year 4 yet because we are selling our asset on January the 3rd. At the very beginning of year 4. So our depreciation remains at $52,500. So I'm going to go ahead and I'm going to clear that $52,500. Okay. That would be a debit. Accumulated depreciation usually has a normal balance of a credit. Because I am zeroing it out for this particular asset, now I need to debit the account. Okay. In this case, we have a loss. So I'm going to have a loss. God, I can't type. Here you go. Loss on sale of equipment. So we lost some money. Okay. How much money did we lose? Well, we lost $22,500. Okay. And you're always, very important, always going to clear your equipment account for the amount that you purchased it for, the amount that you had it on your books. I had my equipment for $375,000. Okay. Now what I like to do is I like to make sure that my debits equal my credits, just to be on the safe side. Okay. And they do. Okay. Make sure debits always equal credits. Okay. That is the rule in accounting. Debits must equal credits. So in this case, we are recording cash received of $300,000. We're clearing the accumulated depreciation for $52,500, and we are recording a loss on the sale of $22,500. Okay? So I've got all of my debits first, and then you've got your credit. And your credit will always be for the amount that you initially recorded the purchase for. In this case, we recorded the purchase for $375,000 when we purchased this equipment. Okay, so that is requirement C. Okay, now requirement D is similar, but now we also sold the equipment on January the 3rd, but now we sold it for a little bit more. We sold it for $325,000 instead of $300,000. Okay, so we are being asked to journalize the entry. Okay, so I'm going to do here, this is going to be requirement C. And then this one's going to be requirement D. Okay, for requirement D, we are selling it for $325,000. Okay, so we always start off with the book value. The book value will be $322,500. I'm selling it for $325,000. Okay, so now I'm going to get, it's going to be your sales price minus your book value. In this case, my number is a positive. Okay, I've got a profit, a gain of $2,500. Okay, so in this particular scenario, I made some money. Okay, I sold it for more than we had it in our books for. Okay, so now we have to record that entry, and that also happened on January the 3rd. Okay, so the first question is, how much cash did you receive? According to requirement D, you received $325,000. Okay. We are going to clear the accumulated depreciation, so we can clear out this account that we are no longer going to have because we are disposing of the asset by selling it. Okay. So the accumulated depreciation was $52,500. Okay. Now be very careful. In scenario number D, we don't have a loss, we have a gain. Whenever you have a loss, you're going to debit the loss on sale of equipment account. Okay. When you have a gain, you have to credit the gain on sale of equipment account. So in this case, we have a gain. So I have a gain on sale of equipment. Okay, and my gain is $2,500. Okay, gains are recorded as a credit always. Okay, losses as a debit, gains as a credit. Okay, and last but not least, we have to clear out our equipment account. Okay, our equipment account will always be cleared for the amount that we originally recorded the equipment for. Okay, in this case, it was $375,000. Okay, so I'm going to make sure that my debits equal my credits because I want to make sure that I am in balance. Okay, and yes, we are. Okay, we are in balance. Both of them are $377,500. So this is what the second entry will look like. Okay, the cash that you received, $325,000. We're going to clear the accumulated depreciation that we have for this equipment. We need to remove it from our books. I'm going to go ahead and I'm going to debit it for the $52,500. In this case, we had a gain on the sale of $2,500. So gain on sale of equipment, gains will always be a credit of $2,500. And then we clear out our equipment for the amount that we originally recorded it in our books for, which was the $375,000. Okay. So those are the 4 requirements for this assignment. The key here is calculating your depreciation correctly, because if you don't get this correct, then everything else will be off. Okay. So 4 requirements: calculating the depreciation, the book value, and then journalizing the entries. One in case we had a gain on the sale, the other one in case we had a loss on the sale. Okay. So this is a very good complex problem that will hopefully help you understand better when you're completing your homework. So that is basically it for this lecture. If you have any questions, do not hesitate to contact me. Make sure that you do read before attempting any of your assignments. And if you do have any questions, if you can please be specific on the question, explain what is it that you understand, don't understand, or are looking to understand. And if it's problem solving based, make sure that you do include your step-by-step calculations. Okay, so that is exercise 918. I'll go ahead and leave you for now. I hope you have a wonderful rest of your week, and until next time, thank you.